Hi, I'm Marcie Hill, and today on What Matters to Miss Marcie, I am talking to Miss Melantha K. Paige about the new tax laws that were introduced. And Melantha, can you introduce yourself, please?
Sure. Hi, Marcie. It's nice to talk with you. Again, my name is Melantha Page. I am a CPA from Pennsylvania, and I own Page Consulting Services, LLC, which is a small CPA firm based out of Philadelphia in a little town called Bala Kenwood. I'm very excited to be here to talk to you about the new tax law.
Well, thank you so much. And I really wanted to speak with you because I have read tons and tons of information about how it should impact individuals and small businesses, and I still have no clue. So, what were some of the things, major changes that what are some of the major changes we can expect? Just in general, like
Okay, in
that
general,
impacted everybody.
all right. So this bill is significant for a lot of reasons. And one of the main reasons why it's significant is that it's the most significant change in the tax law in over 30 years. So essentially everything that I learned in college and in grad school and on the CPA exam about taxes has changed at the end of this past year. There's been a lot of provisions that impact individuals and businesses. On the individual side, a few of the things that really come to mind are the tax brackets. The tax brackets have changed in the sense that the values have gone down. At
Wow.
one time, the highest tax bracket was 39.6%. Now it's 37%, and it continues to kind of step down to the lowest tax bracket, which is about 10%, which is going to result in most people, at least temporarily, seeing a little bit of a tax cut at the individual level.
So color me slow. What does a tax cut? What does it mean to
A
cut?
tax, the simple way to describe a tax cut means that you'll notice an increase in your paycheck because the amount of taxes that are deducted from your paycheck are going to be slightly lower because the brackets have been expanded, meaning that there are more dollars included in a particular tax bracket as far as the range of salaries, and the tax rates have gone down a few percentage points. So you're going to notice, most people are going to notice that their taxes, that their paychecks that they receive every 2 weeks are going to be a little bit bigger.
Okay. And now what are some of the changes for businesses? Because there's a big to-do about the tax cuts for them and also the wealthy.
Oh, yeah, we're going to definitely talk about that. So before we go to that, one thing I want to tell you about the changes for individuals is that they are temporary. So the tax cuts that I just described to you and some of the other areas that we can discuss, they're temporary in that after December 31st, 2025, they go away. And unless somebody else makes another change, then they go right back to what they were before. The business changes, the corporate and business changes are permanent. So that's another issue that people are having with this bill. It's like, why do we as individuals get the temporary stuff and the businesses get the permanent? Another thing with the corporate and business tax rate is that the highest rate used to be 39.6, and then there were graduated tax rates below that, like 37 and 35, and I think the lowest one was 15%. Now there is a across the board tax rate of 21% for corporations and businesses. So that's very significant because that means that businesses are getting to keep more money of what they earned, which is part of what some of our government officials think will lead to something called the trickle down, which means that they'll spend more money on things that benefit their employees and benefit the general public because they have additional money to spend. That's sort of the basis behind the tax cuts.
But I believe that's probably garbage because they have enough money now and they're not giving to their employees or to
I agree.
the communities in which they live. Well, that's just my opinion. But
I happen to share that opinion because the trickle down just theoretically doesn't work. There's a lot of evidence that supports that. I won't bore you with that, but it's something that has never worked. Every time there's been a big tax cut for the wealthy and for the business class over the past 30 or 40 years, wages for individuals have continued to grow at a snail's pace. While corporations will buy back stock and continue to raise their CEO bonuses and so on and so forth, that money doesn't really get to the, people like you and me, the people that are, working, or, those who work for other people. So it's very interesting bill. Other things on the individual side that I think are really important for people to know is that the standard deductions that you're allowed to take as individuals based on your filing status have been doubled. So the single standard deduction used to be $6,350. It's now going to be $12,000, which means that you have more of a standard deduction to be able to reduce your gross income to arrive at your taxable income, which means that, that's another way that they're selling the tax cut. But one of the downsides is that they are getting rid of something called the personal exemption. The personal exemption is another deduction that individuals were allowed of $4,000 per person to help reduce their gross income at arriving at their taxable income. And now that's going away. So, as they say, God giveth and God taketh away. It's the same thing with the tax system. They're giving some things in the form of higher standard deductions on individuals, but they're taking away certain things like the personal exemption. They're offering additional monies for child tax credit, but they're taking away deductions for people for like unreimbursed business expenses from your job. Like, let's say you have to buy uniforms for work, or publications, or you have expenses from work that are not reimbursable. There used to be a way for you to deduct that. Well, now those costs are not deductible.
Wow. So which do you think is better for individuals, the personal deduction or the new option?
I think it's going to depend on everybody's situation.
Okay.
I could say that normally for me, I itemize my deductions because I own a house, so there's some additional things that I can take there. But depending on the certain changes that they're making to the law regarding what you can deduct on as an itemized deduction, it could be that the standard deduction, because it's going to be double, might be better for me. So the one thing I try to tell people is that there's no such thing, as a one-size-fits-all when it comes to the tax process. So these laws, they look good on paper, but you really won't know the true impact to you individually until you sit down with your tax preparer and have them kind of review your documents. One of the things that I'm doing for my clients is I'm taking their 2017 information for them, and I'm applying the 2018 laws to kind of give them an idea of how things might look next year when we file their taxes.
Okay, so when are these new laws expected to take place?
Well, most of them are starting as of January 2018, but there are some that won't start until January of 2019. One of the ones that won't start until, two of the ones that will not start until January 19th are the Affordable Care mandate. That's where you're required to have health insurance, or else you pay what folks call a penalty, but it's actually called the shared responsibility payment. This is the last year in 2018 where you will have to pay that if you don't have health insurance. Another change beginning in January of 2019 is related to alimony for divorces after that period. If you, right now in 2017, if you got divorced in 2017 and you paid alimony, you could write that off as a deduction. Wow. And the person receiving it would have to document it as income. Now, once 2019 starts, you won't be able to deduct it, and the person won't have to the person won't have to include it in their income. So that's going to be kind of sticky, because people aren't going to really, I guess both sides will be upset. Like, the person probably doesn't want to pay alimony anyway, but at least they got a tax deduction. Right. But the person who received the alimony wants to keep the money, but they didn't want to pay taxes. So it kind of cancels itself out on both ends.
Oh, that's unfortunate.
Yeah, that's unfortunate. I mean, divorce is a very difficult thing, but it was kind of fair in that, okay, if I have to still pay you for a set amount of time according to this divorce decree, at least I get a tax deduction. And it was a favorable one because it was what we call an above the line deduction. So, but now it's going away.
And could you explain what an above the line deduction is?
Sure. So when you do your tax return, you start with the income that you earn from all sources. That could be like a W-2 or any 1099s. And then there's certain deductions that you can deduct to arrive at your adjusted gross income. Some of those would be student loan interest, which the law is changing about that. Some of them would be self-employed health insurance, 1/2 of self-employment tax, and another common one is the educator deduction. I don't know if you've heard, but sometimes teachers will deduct part of their supplies that they pay, but they only allow you to deduct up to $250. Now, those deductions are, yeah, that's not a lot. I know I have teacher friends and they pay way more than that, but they get the $250. So
okay.
The importance of the deductions, the above the line deductions, are that they are taken into account before itemized deductions, and it could help you to qualify for certain deductions and credits that are impacted by your adjusted gross income. So if you have things that you can do to reduce your adjusted gross income, then it might help you on the other side to be able to get bigger deductions later on in the process as you do your taxes, because a lot of taxes are based off of how much your adjusted gross income is, and some of them will phase out once it gets to a certain point. So that's why the adjusted gross income calculation and the above the line deductions are really important. And alimony and student loans were a big one. A lot of the students or people who paid student loans like me, they're going to have a rude awakening because, starting this year, if your adjusted gross income is $80,000 or more as a single person, you can't deduct student loan interest anymore. If you're a married couple, it's $135,000 together. And so if you figure you got two people that make $70,000 in a household and they both paying student loan interest, they won't be able to get that deduction. I mean, it's completely phased out. Now, there's some other lower incomes that will allow them to take some of the deduction away. But when you think about it, an individual making $80,000, I mean, that's a good salary, but there's a lot of people that make in that 70, 80, 90, low six figures range, and they're paying out these expenses for student loans, and they're not going to be able to get that back. So that's going to be problematic for folks when the time comes, because again, it's an above the line deduction. So now it's keeping your adjusted gross income higher to the point where you might not qualify for other deductions in the other parts of your return because of it. So that's why above the line deductions are important.
Okay, so I'm just sitting up here listening, wondering what was I was just thinking, what was this guy thinking? But yeah, we won't even go into that conversation.
I understand.
Because that's so loaded. And then I feel like just listening that of course, middle class, if we still have one, or the working class will be impacted mostly by the changes. For the child, did people have to, I'm trying to figure out how to ask this question about child support. Was that a tax write-off?
No. Now, child support was always not deductible to the person paying it and not taxable to the person receiving it. So now alimony is characterized the same way as opposed to how it was before. So no, it's never been taxable. It's always been tax-free to the person receiving it and not deductible to the person paying it. So that hasn't changed. That's going to stay the same.
And how are wealthy people, first of all, define wealthy, and then how are they impacted by the tax laws? Because, you read different things, and I don't have one source as to what wealthy means, what it is. So, according to the tax laws, according
to the tax laws, well, according to the tax laws, you're included as part of the 2% of Americans that make over $100,000 a year. So if you look at the tax code, they're considering anybody who makes over $100,000 technically wealthy, because only 2% of Americans make above $100,000 a year. And then 1%, the 1% are the ultra rich who make millions and millions of dollars a year. And the thing about that is that most of those people that are considered the ultra wealthy, not the people who make 100,000 or even 200,000 a year, they're sort of subjected to the same things that I would be subjected to. You know, when I worked in corporate America, I was subjected to the same taxes. It's the ultra rich who really do benefit. So because they earn income in a different way. So by the time you become a ultra rich person, I won't say any names, but you're not earning what they call wage income. You're earning income off of your investments. So those are taxed totally different. So they end up paying a lot less in tax from a percentage perspective versus what you would pay as an individual. Some other ways that they're benefited that I think what your subscribers and your video watchers would like to know is something called the estate tax. So the estate tax is something that a person pays after they pass away. Some people call it the death tax. And there's an exemption amount of $5 million that they won't tax. Now, I think $5 million is a lot of money, but that exemption has now increased to 11.2 million. It was 5.5 million. Now it's 11.2 million. So they doubled the tax break for estates for wealthy people, which means that most of their, they get to keep most of their wealth to pass on to generations in the future, as opposed to, and those are permanent, as opposed to the tax cuts that we're going to be getting, which are going to be temporary as well. Some of the other things for small businesses that I think are important, one thing that comes to mind is entertainment expenses. There was a time when you can deduct what they call meals and entertainments as a business expense. Mm-hmm. You can still deduct meals so long as they're business meals, but you can't deduct entertainment expenses. That's a pretty common one that I see in my practice, where, you know, especially in my business as an accountant, sometimes I have to go to networking events and take a client out to lunch. Now, the client lunch would be deductible, but let's say that I purchased the client tickets to a baseball game or something. That wouldn't be deductible to me anymore. At one point, there was a deduction for that.
Because when you said entertainment, the first thing I thought was the rooftop at Wrigley, even though I know they wouldn't go to the rooftop, but that was the first thing that came to mind.
Yeah, those things are no longer deductible. Also, on the individual side, moving expenses. There used to be a time when you could deduct as an above the line deduction. Really? Moving expenses, so long as you met a certain requirement as far as distance away from your job and the new house and all that. There was a whole calculation around it. Now you're not allowed to deduct that unless you're a member of the armed forces. I love our troops. I support our troops. But I think that, you know, other taxpayers should get the benefit of deducting moving expenses as well. They took that away. That's something that we can no longer do. A couple of other ones that comes off the top of my head: home mortgage interest. There was a time when you can deduct the interest off of a mortgage up to $1 million mortgage. That's now been cut down to about $750,000.
I thought you were about to say $750. I was about to fall out.
No. I'd probably be crying if they said that, because I'd be like, I can't write off my own interest, but $750,000. And that might not seem too bad, because a lot of people aren't buying $1 million houses. And it really would help the middle class in that most of us are buying houses in the $100,000, $200,000, maybe $300,000 range. But what's very, very interesting that they changed was that you used to be able to deduct home equity loan interest. So a person gets a home equity loan. If they do the right thing with the money and they fix up their house, you can get a deduction for that. At least you could. Now you can't deduct the interest for that. You can no longer deduct the interest for what they call home equity indebtedness. That's not allowed. And a lot of middle class people, unfortunately, were using their houses as piggy banks and taking money out of their homes and not doing repairs and things that add equity to the house. But some people were using it to go on vacations and, you know, pay other debt. And then they were able to get a tax write-off for that. That's no longer allowed. One more that I think is interesting is casualty, theft, and loss. It used to be times when you, as a person or as an individual, you could deduct personal casualty and theft losses. But it had to be in excess of whatever the insurance company paid you back, you know. Mm-hmm. Now you can't do that unless it's associated with a federally mandated disaster. So a Hurricane Sandy, or, you know, You know, it has to be something like a major federally declared disaster for you to be able to deduct it. So again, some of these things were, I don't know, these were things that individuals are used to having, and I think it was fair. And now they're just taking away all kinds of things. And so it's going to be difficult to know how it's going to impact the individuals until they actually sit down and do their taxes. I've asked all my clients to set up a 30-minute consultation with me if they would like, to kind of look at their 2017 numbers and compare it to what the 2018 laws are, because it's very, very, you need to plan. Like, if you got to make sure you have enough money withheld out of your pay. You need to make sure if you're putting in your 401k that you're taking advantage of those tax shelters. It's so, you know, as they say, there's levels to it. There's so many levels to it. And we didn't have enough time to prepare for this law because it was sort of pushed down everyone's throats. Now, the light at the end of the tunnel, Ms. Marcie, is that whenever any new law is implemented, it goes through something called technical corrections.
Okay.
So that's a fancy way of saying this might not be a good law in practice, and so we can have an opportunity to make some changes as we go along. So a lot of us in the industry are hoping that as the year continues and they see the impact of some of these laws, some of them didn't even read the bill. Don't get me started on that. They've signed the bill, didn't read it. But hopefully some of these technical corrections will come out, these comments will come out, and some of these changes, at least on the individual side, will be changed back or just made a little less onerous on the everyday person. I mean, I think the businesses are going to be fine. They have lower taxes across the board. There's additional opportunities to write off net operating losses over the different carry forward and carry back periods. There's pass-through entities like LLCs. They're going to be able to deduct some of their qualifying income depending on what type of business they have. So the businesses, I think, are doing okay. I mean, there's increased in your ability to be able to deduct something, to deduct equipment under Section 179. It used to be $1 million. Now it's up to like 2.5 million. So I think that the businesses will fare well in this. If you remember, the tax cuts for them are permanent. So they don't have to worry about something changing in 2025. But those other things that I talked to you about on the individual side are most definitely temporary. And as of 2025, December 31, they will either revert back, which in some cases might be good, like, ooh, I get to write off my alimony, you know, again, or, you know, it might be bad, like, ooh, all these tax rates, they went up again. So now my paycheck went down. So it really just depends on how everything plays out. And I'm hoping that the technical corrections and maybe a change in administration and Congress might not subject us to this bill forever and ever.
I did have a question. Okay, and this has nothing, it does have something to do with taxes, but not the tax laws. How are people, you know how you do your tax forms for work, the W-4s?
Yes.
People always ask, what should they, you know, how they should complete it. And I was told if you put 0, you get more, you get less back now and more back later or something like that. And if you put, the higher the number, you get more. Yeah, you get more back now and then less back later. Can you explain that for us, please?
Sure, Marcie. The form you're talking about is called a W-4. And what that does is it tells the IRS, well, it tells your employer how much money to withhold from your pay. So if you select 0, that means you're selecting to be withheld as 0, meaning single at a higher rate. You can also claim 1 for yourself, which is single. And then you're supposed to only claim additional exemptions based on your household. So if it's a husband and a wife and 2 kids, each of them could claim 4 exemptions. I tell people to be careful with that because it does impact how much is withheld. And you don't know whether, because you chose a certain exemption type or a certain number of exemptions, that whether you're going to end up owing when you go to do your taxes. Because what happens is when you do your tax return, you're going to have to settle up with the IRS. They're going to say, okay, this is your gross income. Here's all your deductions above the line and below the line. And here's what your taxable income is. And here's what the tax is on what your taxable income is calculated to be. Okay, you got any other credits or anything that can reduce that? Okay, now we reduce that. Now let's compare it to what we withheld during the year. And that's how you determine whether someone owes or whether someone gets a refund. That's why that form is very important. Some people like to see more money in their paycheck. And I can certainly understand that. But you have to really be mindful. Don't take too many exemptions unless you can carry that on your return. And remember when we talked about the personal exemption, where you got that $4,000 for each person as a deduction?
Mm-hmm.
That goes away on your tax return. That directly correlates, really should be equal to what you would be taking on your W-4 form. So right now, if there was a family of 4, there would be 4 exemptions. But then when you do the tax return, you'd have more of an opportunity for you to break even. But if you know that you're single, like it's just me, and I take 6 exemptions, and then I go and do my taxes, and I can't take any exemptions at all because it's gone. Now I've had not enough withheld, and they're going to calculate my taxable income based on these, temporary tax credits and tax cuts that I might phase out of because I made too much money. And then at the end, I may end up owing. So that's why I'm recommending that people be very conservative in their exemptions. Be honest on the W-4 form. If you're single, take 0 or 1. And if it's just you and one other person, or you have 1 kid, just do you and one other person. That way you have the money coming out that you're supposed to have coming out. Because the last thing you want to do is get stuck owing at the end of the year. Because when I tell you they want their money when you submit the return, if you owe, they want their money then. You can get a payment plan, but you'll be paying interest. And depending on what happens, how soon you file it, you might be paying penalties. So that form is very important, Marcie. It's a good question.
And then I only have one more question. Well, 2.
Sure. All right.
So I've been reading that a lot of companies are giving employees bonuses. Mm-hmm. Does that have anything to do with the current tax laws?
Absolutely. Absolutely. When those tax laws were announced in December and it was clear that they were going to be passed, a lot of these companies, they started chomping at the bit. Like, wait a minute. That means that I can get me another deduction for 2017. So they decided to give bonuses out. Now here's the thing about bonuses. So on the employer side, I get to deduct that as an employee benefit expense. Okay, so I get a deduction. But as an employee and receiving a bonus, that bonus is going to be taxed at like 40%. So you're not even going to get all of it. And then it might put you in a different tax bracket, which means you may end up paying more taxes. So it's good to have the extra money in your pocket. Hey, I like getting the bonus. When I was in corporate America, I always appreciated the bonus. But I always knew that I needed to defer part of it and put it into my retirement plan so that all of it didn't get taxed. You know what I mean? Mm-hmm. So, the businesses are doing it. And I mean, I'm not knocking them for doing it because they got themselves a tax deduction and people got their additional $1,000. So that was nice. But also, shortly after that, many of those companies laid off people in the masses. So it kind of like, it's like 6 in one hand, half a dozen in the other. But it's directly related to the tax cuts because they know now that they can get a bigger deduction at the end of the year. So, why not? They're going to have more money beginning next year because they got their 21% corporate tax rate down from 39.6%. They got all their other fancy deductions that are permanent. So let's spend some more money this year. And in 2018, they got rid of a bunch of people in January anyway. Like I know AT&T did that. Specifically, there's a lot of different companies, but AT&T was one of the ones that was on the news.
Why did they let people go?
The main reason why I believe companies let people go is a pretty common sense reason. It's about the bottom line. Like they want to save money. And so the idea is, what's their biggest cost? Most companies, the biggest cost is people.
Labor.
It's labor and benefits. So if I can get rid of people and have my team do more with less, I'm going to do that because then it's going to allow me to take those profits from the business, which are going to be bigger because my expenses are going to be lower. And I can take that money And if the trickle down worked, they would take that money and they would invest it in employees, but they're not, because they're getting rid of employees. They don't want to do that. But what they do is they take the profit and they'll go back and they'll buy back stock, or they'll go and do something that benefits their shareholders. And that's what a corporation, that's the goal of a corporation, is to maximize shareholder wealth. So what you see these businesses doing by pulling people off and laying people off their jobs, they're maximizing shareholder wealth. They're cutting expenses so that their profits can be more, and they can build their equity in their business, and they can use that money to reinvest in the business, buy back shares, and keep the company going. I mean, corporations are about building and growing the corporation.
Yeah, bottom line.
No, about that. It's to imagine you look at your own expenses. You make a certain amount of money, you got a couple expenses, and you got a certain amount of money you used to getting, disposable income at the end. If you end up looking at your expenses and it's a little high, you're gonna have to get rid of some stuff. I just did the same thing recently. I got rid of some of the memberships that I had to various things because I just said it was just not necessary. So I had to cut those. Businesses doing the same thing. And they're going to take that money left over and reinvest it in the things that they want, that's important to them, which is basically buying assets, acquisitions, buying assets, and stock buybacks.
So they'll just reinvest and continue to grow their bottom line.
Oh, absolutely.
Okay.
Absolutely. And that's why it's important to have a government that really, is focusing on making sure that they pay their fair amount of taxes. That's why this cut from the highest rate being 39% all the way down to a blanket rate of 21% is very interesting, to say the least, because they should be paying their fair share. At least I think so. And we all pay our fair share.
So what do you think? Did you think that 39% was the fair share?
Well, we have what we call a graduated progressive tax rate. So the 39.6% is actually the highest rate. It's based on your profit.
Okay.
Like how much profit you make. So the lowest is 15%. Then you have like 22, 25, okay. 35, and 39.6. That's the highest rate. Yes, I happen to think that they should pay whatever's associated with their taxable income, just like you and me. Because a lot of these companies still get a refund. They still get billions of dollars in refunds at the end of the year when a lot of individuals owe. So that's we can do a whole nother talk about just that one day.
I do have one more question. It came to mind. You know how you I've been completing applications for employment, and they have the work tax credit or something.
Okay.
What is that, and how does it work?
Oh, the work tax credit. So what the government does is they will give a tax credit to the business if they hire people in certain fields, or if they hire like certain types of employees. So for example, let's say that a company was like, okay, I'm going to hire people that have a felony because I want to give them a chance to work and re-enter society. That's a very noble task, right? Because it's hard to get a job when you have a crime on your record. So right. What will happen is the government says, okay, to give you a benefit for doing that, they'll give you a tax credit for that. So that's pretty much what they do. They do that sometimes for criminal felons when they want to hire them, or they'll do that to hire disabled people or veterans. Sometimes they do it for people who are coming off of public assistance. It's just an incentive for the business to hire more people. So, because you think about it, if I'm a business, I get a little tax credit, I hire a bunch of new people. What are those people going to do? They're going to earn money that's going to be paying taxes into the system. They're going to spend their money, which is going to go into the economy. They're probably going to run up some credit card debt and pay some interest to some banks. They're going to buy clothes. They're going to buy food. They're going to drive cars. They're going to take the bus. They're going to build the economy. So it's sort of like a partnership. Those types of things are actually good things because, why shouldn't they get a little something for hiring more people if they can just sit back and say, what's my motivation for hiring new people? So if the government can give them some motivation, like, okay, here, I'm going to be your motivation. Here's a few extra dollars for doing that on a tax credit that you can take on your tax return. But look at the benefit of the people. You get the job, you get to spend the money, the people get to buy your book, or they get to purchase my services as an accountant, which then goes into my pocket and your pocket, and then it feeds the economy.
Right.
That's how
Keep
the
it
economy grows.
going. So those were the questions that I had. Did you have anything else you wanted to add as far as tax laws?
The only thing I would add as far as the tax law is that people need to understand that this is a 1,600 page tax bill. It's very, very complicated. Don't try to assume how it's going to impact you. Contact a tax professional if you want to know the specific way that it's going to impact you. Or even visit the IRS website or one of their field offices, because they can help you as well for free. But just understand that it's still early in the process, and there's probably going to be more changes this year as the bill starts to be executed and the government sees the impact.
And you mentioned assistance. How can people find you? Well, I don't know if you're available to help people. If you are, let us know.
I am.
Okay, and how can they find you online and ask questions?
Okay, definitely. I'm definitely available online. I'm all over social media. We do have a business page. It's called Paige Consulting Services LLC, which is on Facebook. We're also on Instagram. We have a website, www.pcsllcsolutions.com. If you visit there, we have a free monthly newsletter that you can sign up for, where you can get free tax tips all year round, as well as information for small business owners, QuickBooks, anything that you can think of related to individual or business tax and accounting services. And you can also subscribe to my blog, which is called Ask the CPA, which is basically, it's a blog that I write, and I also do videos on my Facebook page, and we talk about just different topics that are of interest to individuals and businesses. My goal is to present these topics in a manner that's easy to understand and relatable. Some of the topics that we've discussed are IRS impersonation scams, 5 things that your accountant wants you to know before you start your business, and is your tax preparer legit? So I try to keep it relevant to my subscribers and my readers, and to keep it relatable. And it's called Ask the CPA.
Okay, well, thank you for your time and your knowledge, Paige.
Thank you.
And I will catch you on the other side.
All right. Thank you, Marcie. And thanks for having me today. Have a wonderful day.
You too. Thank you.